Chapter 14, Suitability and Recommendations. Video 4, Managing and Measuring Risk. In this video, we'll discuss various risk management methods, how to calculate risk using volatility measures, and review industry models and theories used to aid portfolio managers in investment returns. Imagine if the portfolio was invested in hundreds of different securities, but they were all equities or all bonds or all from the same sector. Diversification helps reduce non-systematic risk by spreading risk over multiple securities from different issuers, but diversification is only part of the solution. Asset allocation can help build an optimal portfolio using multiple asset classes such as cash, stocks, bonds, and real estate. The proper asset allocation will vary based on the client's risk tolerance. An investor with a low risk tolerance will have a heavier weighting in cash and bonds. An investor with a high risk tolerance will have more stocks. Over time, it will be important to rebalance the portfolio to ensure it stays in line with the risk tolerance and objectives of the investor. Passive portfolio rebalancing automatically removes dollars from the overperforming assets and reallocates them to the underperforming assets, either quarterly or annually. Active portfolio rebalancing requires the representative or portfolio manager to remove dollars from the underperforming assets and to pick the assets the manager or representative believes will outperform. Hedging is a method used to reduce systematic risk. Investors could purchase options on broad-based indexes to protect from an overall market decline. For example, an investor could buy puts on indexes or sell ETFs short. If the market drops, the investor will profit from the decline and offset the losses in their portfolio. To measure risk, we need to understand the risk-free rate of return. The risk-free rate of return is a return where it's assumed there can be no losses and the investment is extremely safe. The generally accepted standard for this is the Treasury bill, since it's believed to be safe and it has a short maturity. The return on the Treasury bill, or sometimes called a T-bill, is risk-free. So any return that is generated above must involve some sort of risk. The difference between an expected return of an investment and the risk-free rate is called the risk premium. While beta measures the volatility of a security as compared to the entire market, alpha is the actual return compared to its expected return as measured by beta. A positive alpha indicates the security or portfolio outperformed its expected return. A negative alpha indicates underperformance. Alpha measures actual performance. For example, the fund manager of XYZ large cap fund may have their performance compared to the S&P 500. If the index had a 10% return and XYZ fund had a beta of 1.1 with a 12.5% return this year, the manager has provided value with a positive alpha of 1.25. Volatility is a relevant benchmark that measures the frequency and size of fluctuations in a security or portfolio's value compared to the overall market. Volatility is often measured in terms of beta. Beta attempts to measure the volatility of a security in comparison to a benchmark index. A beta of 1 means the security or the portfolio is expected to move in tandem with its benchmark index. It will have the same degree of volatility as the index. A security with a beta greater than 1 is more volatile than the overall market and so it's expected to have a return that varies to a greater degree compared to the benchmark index. A security with a beta less than 1 indicates less volatility, and so that's expected to have a return that varies to a lesser degree compared to its benchmark index. A negative beta indicates the security is moving in the opposite direction of its benchmark index. So to calculate the expected change in the stock's value relative to the change in the benchmark index, simply multiply the benchmark's expected rate of return by the stock's beta. The capital asset pricing model is used in the modern portfolio theory to determine the most efficient investments. It attempts to find the required rate of return, or RRR, for an asset or portfolio. RRR factors in any risk taken above the risk-free rate. Note that the T-bill rate is typically considered the risk-free rate. The capital asset pricing model uses the risk-free rate to represent the time value of money and the beta of that security in the calculation. From this calculation, an expected or required rate of return is derived for a security. The efficient market hypothesis, or EMH, is a theory that states that all information about an issuer is available to all participants in the market at the same time, and the prices of securities directly reflect investor expectations based on this information. Therefore, attempting to profit from buying undervalued stocks or selling short overvalued stocks is futile. The three forms of this theory are weak, semi-strong, and strong form. The most accepted EMH theory is the semi-strong version, which states that market valuations reflect all public information about an issuer. It does not reflect information known only by insiders. Weak form EMH states that all information incorporated from past price information is reflected in current prices. So the weak form believes that fundamental analysis can beat the market. On the opposite end of the spectrum, the strong form believes all information, both public and private, is reflected in the current prices. So this form says the market is efficient in pricing securities and cannot be beaten.